buying a house or a car could cost you even more soon. The Federal Reserve is hiking interest rates by 0.25%, and that will have an effect on credit cards, some loans, and more. CBS 8's Richard Allen has been working hard to find out how the spike works and why some families could actually benefit from it. Richard?
Well, that's right. This is the first time the Fed has raised interest rates since 2018 in the face of rising inflation we haven't seen in 4 decades. The hope is that this rate hike will help control that inflation, meaning we can expect even more rate increases down the road.
We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
By raising interest rates, the Fed hopes that demand for consumer goods and services will decrease and better match supply, which economists say will eventually moderate prices. But for those who want to borrow money, this rate hike is not welcome news.
If you're a debtor, then definitely this is going to hurt you.
USD economics professor Alan Jin says this is going to make San Diego's already difficult housing market even more so, as mortgage rates and payments could likely climb, and financial requirements to qualify for a loan would tighten.
That might price some people then out of the housing market who were just on the edge.
Meaning that now may be a good time to try to refinance before rates rise even further.
Even though we already had one today, if you could get in there and lock things in, that might help you avoid then further increases in the future.
People paying with plastic will also be impacted. Market analyst Ed Moya says you can expect to see your credit card's annual interest rates creep upward.
If you have, excessive credit card balances, you really want to try to address that and get that down as fast as possible.
There is some good news, though, for savers.
You may see a small increase in the amount of interest you earn on a savings, a checking, a money market, even a CD.
Despite these rate hikes, along with the uncertainty posed by the war in Ukraine, some economists believe we can weather this storm, pointing to strong GDP growth rebounding from the pandemic and a tight labor market with the national unemployment rate currently under 4%.
The economy is strong enough that it could withstand both the increase in the price of oil and an increase then in interest rates.
And this is only the first of an expected series of rate hikes by the Fed. Experts say there could be several more similar increases throughout the rest of this year.